Hello, everyone. We're delighted to welcome you to this webinar discussing our latest view on the most attractive markets for investment in renewables. We recently published the first edition of our Renewables Market Scanning Report. This includes our global index for attractiveness of investment in renewables. And we're very excited to share some of our findings with you today from that study. I'm Mark Turner, partner in Baringa's energy team and an expert in power markets. I'll be chairing today's session, and I'm pleased to say we've beamed in 4 of Baringa's regional leads from across the globe. So welcome to Francesca, Gerardo, Tom, and Jean-Louis, who will be sharing their insight on renewable investment themes and trends in Europe, LATAM, and Iberia, the US, and Asia Pacific, respectively, as we go through the session. Before that, I'm going to guide us through some of the main findings and thematics from our attractiveness index. I should say just before that, please do feel free to post questions for our experts as we go along. You can use the Q&A box on your screen, and we'll certainly reserve some time towards the end of the webinar to discuss and to answer some of those questions. And so hopefully that's all clear. Let's press on, and I can give you a bit of an intro to our index and to our study on RES attractiveness. So first of all, to say our index is not merely a qualitative exercise or based on market interviews. We've drawn on the full wealth of analytics, projections and IP from across Baringa. We've got about 60,000 data points which have fed into our rankings, along with our global network of market experts. And so there are 6 key components to the ranking for each market. And the 2 biggest components are, first of all, capacity growth, and then profitability. So on the capacity growth side, this is all about the size of the opportunity in a particular market, looking at installed capacity, the future growth of that until 2050, and looking at that on both an absolute basis and a relative basis as well. So 30% weighting on that growth story. Then secondly, profitability, 30% on that metric. Here we look across markets at the capture price, the realized prices, the revenues that we expect for renewables coming from our detailed projections of power markets. And we compare that to the levelized costs, taking into account things like the discount rates or the cost of capital in particular regions and for certain technologies. So that's another third of the index. Then we have 4 less strongly weighted elements, but still quite important for the overall scoring. We have market liquidity. So with that, we look at some of the transaction trends. What is the value of transactions in renewables over the last few years in the relevant market? Policy environment looks at the stability and the level of policy support for renewables and how durable that is. So do we expect that to change, or is it pretty fixed and pretty certain? Ease of development. Here we look at some of the barriers to development in particular regions. So permitting, grid, planning permission, and we've leveraged some of our expertise and network globally to get a real insight into those issues for each global market. And then finally, macro risks. So some of the political risks that we see in particular regions, regulatory quality, political stability, corruption, rule of law, credit ratings, and how they feed into the environment in that particular region. So all of those 6 factors together make up the final score. And so with a drum roll, here we have the big reveal, which is our ranking of attractiveness for global markets. You can see we have an overall ranking here and then separate scores for onshore and offshore wind and for solar PV. And of course, beneath each of these headline scores, we have the breakdown across each of those 6 metrics that I just went through. Looking at the top 10 here, then, we see that the US features prominently, as does India, and then Spain, Germany, Japan, and Great Britain. You'll see that for the bigger markets, so for India and the US in particular, we score both the whole country and also the separate regions or ISOs. And that's simply due to the scale of those markets. And also because, as we'll see, the attractiveness can vary substantially between those different regions within those markets. We include 2 different versions of the index in our study. The first that we just saw is on a merchant basis. And here we have the second, which takes account of subsidies that are available in particular regions. And here in the subsidy version, we're listing only the regions of the US and India, not the market overall, because the subsidies vary significantly within country. And here you can see on a subsidized basis, Great Britain, Germany, Spain, very firmly at the top of the ranking, ahead of the likes of ERCOT, MISO, and also France and Italy. And here, thanks to the revenue certainty provided by many of the subsidy schemes in operation, things such as CFDs or feed-in tariffs, the cost of capital of the subsidized asset is lower, and also the levelized costs therefore decrease. In the US, we're factoring in the effect of tax credits, which also help to reduce those levelized costs. So now I want to just touch on 2 or 3 of the thematic highlights, so some of the themes that we draw out in our study and in our report. And first of all, on profitability and on capacity. And so here we can really see a bit more clearly the role that subsidies play in improving the profitability for renewable assets, both in Europe and the US. We look at this chart to really zoom into capacity growth and profitability as key indicators for investors, and accurately predicting the timing peak of those metrics. So when might the profitability of a particular region be at its peak over the coming years? And when will the most capacity and the quickest growth occur within a market? Identifying that can really help spot a kind of sweet point for investment. So here we plot those metrics of capacity growth and profitability on a classic 4-box grid. So we have the lower opportunity markets in the lower left, so low profitability, low capacity. And in the top right, we have our sweet spot of high profitability with a large scale of opportunity. So in this category, we found some of the established European markets, Germany, Britain, Spain, and also large parts of India and also Japan. US ISOs, so the likes of SPP, PJM, and MISO are set to experience high capacity growth for sure, but on a merchant basis, maybe don't perform quite as well as some other markets on profitability. But what we can see from this chart is that does change once subsidies are factored in. So here you can see the gray dots are showing the merchant picture, and then the pink dots are showing the picture once we factor in subsidies. So some of the markets initially classified as relatively low opportunity are lifted out of that lower 2 segment area. The likes of Ireland, Latvia, Finland, and New York coming out of that lower left-hand box. And then, yeah, as I mentioned a bit earlier, what we're seeing here with the subsidies is for Europe, we're factoring in that reduction in risk due to the revenue certainty. And again, for the US, we're including that impact of IRA tax credits. So then, maybe the second thematic around transaction and M&A activity as a measure of market liquidity. So here we're showing the value of closed transactions by year and by technology for our different regions. Here, the US is a clear front runner with solar and wind transactions topping around $65 billion in 2023. So that's followed by Western and Southern Europe in terms of overall transaction value and scale. We certainly see that solar M&A activity remains very hot, but wind activity has increased significantly, particularly in Europe over the past few years. We definitely see investor interest remains high, but volatility in financing costs have caused some short-term fluctuations, and we see that, certainly over the last couple of years. But nearly all regions here are showing an increase in deal activity compared to pre-pandemic levels. And of course, I guess the big picture here is that clean energy investment will need to greatly increase over the course of this decade. The IEA figures were, I think, around $4 trillion in terms of investment needed in this decade if we're to stay on track to meet 2050 net zero goals. Then finally, maybe just touching on policy as a crucial element of market attractiveness. And what we show in our study is that attractiveness differs pretty widely by market. We've looked at policy with our credibility and durability methodology. So credibility asks, to what extent do current policies support emission reductions targets, whereas durability asks, will current policies strengthen or weaken over time? In other words, what's the momentum behind policy in a particular region? So high durability and credibility scores would be a signal that emissions targets are more likely to be met. And conversely, low scores would signal that targets are pretty likely to be missed. Generally, more mature markets, while potentially providing maybe slightly lower returns, do offer greater policy stability for investors. But one thing we show in our analysis is that it's pretty difficult to generalize because there can be some quite big differences within regions. So much of Europe, for example, shows pretty strong credibility and durability scores, but still within Eastern Europe, Southern Eastern Europe in particular, we see some policy challenges. And you see that in some of the countries that we're highlighting towards the bottom left-hand quadrant of the chart here. Parts of Asia Pacific and LATAM, such as Vietnam, maybe Malaysia, Mexico, we see gaining positive momentum around policy, durability and credibility. And we feel they're likely to improve their level of policy commitment over the next couple of years. I think the flip side of that, we see countries which are maybe not likely to move in a helpful direction in terms of policy. And I guess the likes of maybe Hungary or Croatia would be countries that we'd flag as being at risk of rollbacks on the policy front. And so with that glimpse, I guess, into some of the thematics coming out of the scan of global renewables markets, I think it's now time for me to hand over to our regional leads for a bit of a deeper dive. And so first I'm going to hand over to Francesca to talk a little bit more about Europe. So Francesca, over to you.
Thank you, Mark. And I have to say, pleased to be here and pleased to represent, the large group of experts that we have operating across all our European offices, from London to Sofia, from Madrid to Copenhagen, and obviously anything in between. As Mark was suggesting, I lead a lot of the work we do in terms of market fundamentals, transaction, commercial advisory. So I have I'm fortunate to be involved in a lot of our advisory work throughout many of the continental European, engagements we have with clients. So when I was asked to talk about Europe, and obviously we had done a lot of work, great work, and we're going to see insights and the results of our study in the material that we'll be able to share with you. It's already available to, hopefully many of you will have seen it. I was more thinking about what kind of additional considerations, what additional thoughts I can basically share with you today as a bit of an augmentation of with my personal opinion of what we see across what I have experienced essentially through client work in the last 6 to 9 months. So when I look at Europe, I think my conclusion, first of all, is I think we have reached a new steady state, a new normal. Obviously, we have experienced a number of years of turmoils, market volatility, difficult economics for renewable projects in a number of geographies. It's a little bit of a European-wide sentiment. But I think finally things are settling down. And I have to say, the long-term fundamentals remain very strong. Indeed, there are challenges, there are things that are not quite right, there are additional complexities. But if you look at, and if I can just share a few examples, especially for our guest here less familiar with the European context, if you think about some of the initiatives led by the European Union, the Green Deal, climate change targets, net zero emissions by 2050, fit for 55% emission reduction by 2030. So all those initiatives, both at European level, but also some of the examples that we have at the national level, are really painting a very positive picture for, across the region. Definitely some positive trends we have observed, and maybe a lot of you will have observed through your project development and investment activities, is definitely the signals around reduction on technology cost, finally, for many of you. Cost of capital remain challenging to some extent, but we definitely see, especially in the solar and in the battery space, good decreases in the capex that obviously have overall a positive impact. It's clear we have still question marks about the ability of Europe of developing their own supply chain, their own production capability, manufacturing capabilities. How much of the cost is actually driven by use of Chinese equipment, how that is sustainable, how is the American situation will change the picture now. So there's a lot of questions remaining there, but it goes without saying we do see those positive trends in terms of capex and investment costs in general. And I have to say, yes, there are pockets where local governments may not so favorable to strong incentives through subsidy regimes, but there are still a lot of positive signals, right? When we look at countries like France or even Germany, obviously it's large markets you have seen in terms of size. We have the EG expected to drive 30 gigawatts of new capacity. Italian government about to launch into new CFD so-called FEREX CFD auctions, again, significant gigawatts of capacity expected through those regimes, right? So anyway, in summary, the fundamentals remain very, very strong. So having said that, obviously there are some complications, there are some bumps on the road. And I'll just name one that is on everyone's mind at the moment, right? I'm not going to say anything new. So to me, the number one is grid. We know there's the problem of scarcity, access to grid. And when I think about grid, I always think about there's a quantum problem, and there's also a quality problem. And we have seen many examples in many geographies. So in terms of the quantum problem is how easy it is for new projects to actually access the connection they need to, to develop their own projects. And there, obviously, we have a lot of delays. An example, like in Poland now, it could take up to 48 months to actually, having connection conditions for a solar project. There's a massive queue, like in Italian space, for instance. So we're all aware of that. It's undeniable they will remain so in the near term, just because the infrastructure, the pace of developing infrastructure is quite challenging, right? It's cables, in the grounds, or, and so on, that will allow, sometimes very slow development of new grid capacity. So that's the quantum side of things. But it's also quality, right? And many of you, again, will have experience through your project experience. So when I say quality is, yes, you access your connection, but how much of that is a firm connection, right? We see examples, for instance, in France, where for speedier access to connection, you need to give up to the firmness of how reliable and how you can take for granted the access to that quantum capacity you're contracted for. So there are several, dimensions there of, maybe you don't quite have a firm connection, but you still can get it quite, in a faster way, let's say, than otherwise. We've seen obviously examples of curtailments coming from TSO instructions. Again, there's an example in Poland. I think it was a little bit of a market failure more than a real, grid concern around congestions. But, we do see all those challenges, and obviously business plans of many of our clients have been revised, amended. We receive a lot of questions around the quantification and the amount of work we're doing. And my colleague will talk to you about is curtailment in Spain, for instance, how much you compensate or not compensate, and what's your monetary exposure to all these events, including obviously negative prices. We have seen the escalation of negative prices across the continent. And some of it, will really draw the attention. Some of these deep negative prices that we do see over time at different pace and different rates in different countries decreasing. But, that sort of risk of commercial exposure through subsidy or through merchant position, through contracted position like PPAs or CFD schemes, that is destined to remain, right, over time. So anyway, these are some of the probably the biggest challenges. One aspect that is actually very, very felt, let's say, throughout all the clients investing in renewables is the requirement of increasing the complexity and the sophistication, the way they structure the project, and the way they assess the actual, economics. We have seen that in the way PPA are negotiated, for instance, liability clauses, termination events, clearly negative prices. So all that has increased the complexity and sophistication. But I think there's a real maturity in how these conversations going on, both from a sell side, from the buy side, and obviously, I think it's a positive signal around the maturity of these conversations. It's very, very, instrumental for more investments, better investments. There's definitely a shift in attention from, developing only to becoming integrated power producers, adding new capabilities in terms of trading, market access, financing, origination. That's definitely clear signals across many of our European clients with maybe just developers at the very beginning in the early days of their business, but they're shifting down as also the value of investments. And we have seen that in M&A is not so much on the developing premium obtainable, but more about in the capability space that an IPP may able to capture through that. Hybridization of models goes without saying. Many of you will have seen that. Solar and wind behind the same connection, batteries and renewables, everyone is looking at this. I have to say, I'm not a strong, super firm believer that you can use storage as just improve your business case for renewables. I don't think that's a primary use of storage because it limits the flexibility and the value that a standalone storage can actually achieve. Having said that, there are pockets of value to be realized, when grid access is scarce, when there's a lot of localized curtailments, when there's high fees. There are really pockets of value when some of our clients are looking to build in those hybridized projects. I'm concluding with a final remark, obviously, around the offshore wind trouble sector. A lot of companies are struggling to bring those investments to fruition. Definitely, we have what we're seeing in terms of the quantums is probably failing, to achieve the maybe a few years ago expectation of capacity we would have had by now on the system. But having said that, yeah, there's a access, there's definitely positive signals of, in some countries like, the UK, we have seen some positive results for the auctions. You may have seen the publication of the last, the ninth round for French offshore. You've seen a long list of companies still interested and actively pursuing investments. recent tender announcements in Belgium for Princess Elizabeth zone, in the Netherlands as well. So we have helped, for instance, the close of the first financing deal in Poland for one of the first offshore investments there. So despite maybe a lower than expected, maybe less easy than expected deployment, we still see the positive signals about some of the setbacks that the industry has obviously gone through and perceiving. I think I'll stop here in the interest of time. Obviously, very, very happy to pick up some of the discussions bilaterally or through the Q&A later on. And Gerardo, I think you're next on the line. So floor is yours then. Thank you, everyone.
Thank you, Francesca. Now, going to Iberia and Latin America, I'll first introduce myself, and it's a real pleasure to be here as partner of Baringa. I'm Gerardo Fernández. I lead our activity on Iberia and Latin America's power market expert. We started covering our views and going a bit through our views that have underpinned our results on the Iberian markets in Spain and Portugal on our renewable attractiveness index. I think that the broad trends that has Francesca been describing for Europe kind of take also into consideration when we cover the Iberian market. As I guess everybody knows, Iberia has been a highly dynamic region for renewables, probably a benchmark in Europe in terms of rapid development and integration within the power system. Iberia benefits from strong natural resources, strong solar PV radiation, and also favorable energy policies in both countries for renewable investment. Actually, as part of our analysis, we resolved that Spain is ranked number 3 in this subcategory in energy policy attractiveness for renewables. As a result, we have been seeing historically, and especially in the last 5 years, an unprecedented growth of renewable generation. Actually, we've seen above 60 years of solar PV and wind capacity in countries in which the combined population is below 70 million. So basically, we are talking about countries which are not significantly big compared to other countries that we are analyzing in our market scanning report, and also have resulted in a high liquid M&A market with above 10 billion per year historically transaction in the renewable space, which basically it's kind of one of the highest markets that we've seen so far in the last 5 years. Now, we understand that this trend is going to continue. As we say, there are countries that are benefiting from strong energy policies underpinned by European ambition and net zero agenda. And basically, we understand that countries that are going to drive primary capex above 100 billion investment in the next decade in renewables for solar PV and wind. Now, when it comes to this, the first question is the power market going to be the same as the power market that we knew 5 years ago? Well, probably in our view, the answer is no. And actually, it's something that we already been seeing in the last year, in which basically we are seeing an increase in interest by sponsors, by IPPs, developers, in order to reinvent the business model to adapt to an environment in which they need to protect their returns as low wholesale electricity prices arises, especially in these regions in the situation on daily hours driven by the hourly profile on solar PV. Now, what we're seeing here in this regards is basically different players, what different measures or levers or things that they're analyzing are pretty similar to what Francesca was already anticipating for other European regions, in which basically they're analyzing what is the way that technology diversification can protect the overall capture price on the project. We are seeing an increasing interest on co-location business models with batteries. There, what we anticipate, especially for the year 2025, is that the capacity market scheme will potentially be in place as probably one of the main regulatory developments. We anticipate that there would be more and more activity. Something that, as Francesca also tackled, higher, let's say, we've seen a higher capital discipline in terms of assess for greenfield developments. What is the actual curtailment risk? And basically it comes to a situation in which basically developers are starting to have to analyze the project at a nodal basis, with something that had not happened historically in the case of Spain, analyze at a nodal basis what is the actual risk on grid curtailment not being compensated. Here on the exercise that we do with the market, we see kind of pretty interesting results from solar PV assets that can be located pretty close, same region, and depending on which is the node that's co-located, we are even seeing grid curtailment above 10% or even grid curtailment below 2%. So it's something that is really have to be analyzed at a nodal basis. And as Francesca was saying, grid is one of the key concerns on the sector. But what's interesting is that the grid is not only in terms of connection, new installed capacity, but also in terms of facilitating the demand really picks up and is able to connect their production centers, and therefore in order to be able to match an increasing renewable push in order to reach the market, together with an increase in demand in order to cover their demand and their clean energy target needs. We're also seeing an increasing interest by IPPs and in this regard in order to how to protect themselves and capture additional value on ancillary services, an increasing interest on what is their role, what is the play I can do by participating in the energy markets. And especially, in the case of these markets, especially in spring months, in which basically we have had low wholesale electricity market prices, and basically the IPPs would have had to analyze what is the value that I'm able to capture participating in ancillary service, secondary band, etc. Basically, I would like kind of a last remark. Let's say the latest trend we're also seeing in order to protect the returns, and what we understand that will continue going forward is demand-backed collocation, exploring to what extent large new consumers as data centers that are thinking on investing in a region as Iberia, benefiting from low electricity prices and high renewables, to what extent this demand-backed strategy can support renewable investment going forward. Now, if we move to Latin America, and I'll start with Mexico. What is our view on Mexico? We understand that renewable investment is going to revamp, and actually what we see in terms of on a subcategory of installed capacity, Mexico is ranked top 13 on our renewable index analysis. And this is going to be boosted basically by the new energy plan recently approved by Claudia Sheinbaum administration. This plan also incorporates certain rules for boosting private investment. However, here, we still want to see the concrete policies for protection of foreign investors. And this factor penalizes a bit our view compared to other jurisdictions in terms of ease for a foreign investor to actually doing business in Mexico. If we move a bit to the south, I guess as the audience will know, markets in South America generally characterized in general terms by high share of renewables, mainly driven by hydro, as countries as Colombia, Peru, and Brazil. And also there are countries, of course, that have benefited from high capacity factors, high solar PV irradiation, and harnessing wind. In general terms, what we see, and maybe we'll come to specifically details on Chile, what we're understanding is that, part of our findings, what's interesting is that Chile was ranked first in the subcategory of ease of development. And basically this kind of, when we compare different jurisdictions, when we do an analysis, what we get to a conclusion is there's a favorable procedure and more accelerating easiness to really reach renewable assets in order to reach grid connection. However, on the counterpart, what we have seen there in the case of Chile is that this high increase, high penetration of solar and wind, and a low grid, let's say, room for improvement in terms of grid connection has resulted that there has been lower returns and therefore impacting negatively on our renewable attractiveness index. The other part, what we are seeing, what is strong interest, and what we are seeing in different markets different investors looking to analyze, it's basically alternative renewable asset classes and to what extent it can be an attractive market for developing of large battery storage assets. If we go to other countries, and I think that basically, the last remark we would like to point out is around Brazil. which, as you see, was not included in when we issued our new attractive market scanning report, but for sure will be part of future data that is now part of our global coverage. It's a market that has experienced a surge of deployment of renewables and solar and wind the last decade, mainly driven by not only strong capacity factors, but also by favorable regulatory scheme underpinned by renewable auctions, economic incentives such as tax breaks, etc. And it's in a market that, of course, has therefore attracted both local and foreign investments, both from primary capex and from the transaction perspective. So for sure, when we update on our future report, we will cover Brazil, and we anticipate that will be one of the markets with highest renewable attractiveness index going forward. Now, basically, this is what we would like to cover around Iberia and Latin America. And now I'll leave the floor to my colleague, Tom Harper, who will cover a view on US, which from what we're already seeing in the Q&A, it's kind of been one of the key interesting themes to be covered going forward. Tom, the floor is yours.
Thanks, Gerardo. Hi, everyone. I'm Tom Harper. I'm a partner at Baringa, running our North American energy market advisory practice based here out of New York. If we could just advance the slides, guys, that'd be great. I think everyone's trying to do that. So for the US, our assessment was that, as you guys saw, that the US was ranked at the top of our assessment of all regions this summer, and that was primarily because the weightings in the assessment are heavily weighted towards the capacity available to decarbonize. As many people know, the US is a large market, slightly larger than the EU, sorry, and there's a lot of megawatts to play for there. Secondly, the profitability of the US can be quite attractive in certain regions, and I'll come on to that. So here on this page, we're looking at the markets that we covered, mainly the deregulated markets. So those are the markets where we have clear market structures, day-ahead price signals, real-time price signals, where PPAs are indexed against those prices and payments made between counterparties. ERCOT scored the highest in that assessment, ERCOT being Texas in the south there. We say that ERCOT continues to be the bedrock of development activity in the US, and what you tend to find with seasoned developers in the market is that ERCOT will always feature to some degree in their portfolio. And the reason for that is because ERCOT moves pretty quickly compared to other markets. So the other markets you see on page are very much what we call invest then connect markets. So the network is built out before projects connect and made sure that that is reinforced and strong enough to take their power, whereas ERCOT is a connect and manage market, similar to the UK or GB, I guess, where projects are connected before the network is potentially ready, but that comes with the risk of curtailment and something that we call basis risk in the US, which is a difference in the price that the project receives from the market compared to the hub price, and the hub price is a trading point for brevity. So ERCOT, because of those features, but ERCOT is very prominent in people's portfolios. We're seeing MISO come forward. That's the region in the Midwest there, from north to south, as an attractive region too. It's had a lot of reliability issues in recent years and suffered from the usual interconnection delays that we've seen across the globe, really. But we're starting to see projects move through and attractive offtakes with very credible counterparties, including utilities in the region, underpin the economics of projects there. Other regions, PJM, SPP notably, are stronger, looking much stronger than they did a couple of years ago, but there's still a few issues there in terms of interconnection delays, although we're seeing attractive PPAs again in the Northeast in particular, so PJM, New York, that's NISO there, and New England. Generally in the coastal markets, what you find is they are premium markets in terms of offtake levels, at price levels, the quality of that price, but they're more difficult to do business in because of higher land costs, higher development costs generally, longer permitting timelines. So those are strategic plays for developers, but they will rely on ERCOT and increasingly markets like MISO to get that churn of projects through to create near-term cash flow. So that's the US as it stands right now. We cover WEC and CERC in our modeling, but we don't have those markets covered in this publication. Interestingly, there's a lot of load growth in CERC in particular, given recent booms in manufacturing and AI-backed data centers. So we're getting a lot of interest down there, and we'll look to cover that in our next update of this publication. Now, stepping back and looking at the US, it's worth considering the differences to some of the other markets we're covering in this publication. The US is characterized by very cheap gas prices. As everyone knows, it's a huge shale gas producer and exporter. This morning, the gas price at Henry Hub is around 4 to 5 times lower than TTF in Europe, just to give an example. And there's no strong carbon price signal universally across the US as there is in the EU with the EU ETS. There are carbon price mechanisms on the coasts, but nothing in between. So what that means is that renewables currently are not at grid parity with gas-fired generation in the country. They have been at grid parity in the past, pre-COVID, when capex was very low and interest rates were very low, but as things stand, generally speaking, they're not at grid parity without subsidy. And that subsidy comes in 2 ways, basically. One is through the federal tax credits that existed pre the Biden legislation, the Inflation Reduction Act that everyone knows about. And the second way is through RECs, which are regional certificates proving compliance with programs that are enabled by state governments. So RECs are very high value in the Northeast, where each year states say to utilities that they must procure an increasingly higher obligation of renewables, and RECs are lowest in Texas and the Midwest, where well, parts of the Midwest at least, where there is really no obligation, and these things are traded a bit like REGOs. So that's how projects make their economics work. And currently, if you take the power price, if you take RECs and you take the investment tax credits, you have a very profitable looking project in these parts of the country highlighted here. Now, of course, we've seen a lot of questions come up about the Trump administration coming in January. We published this in around September, October this year, and we did have an eye on the Trump administration. If we go to the next page, please, Mark, we've got a bit of analysis on this. Now, we do think that the incoming administration is going to make some change to the landscape as it stands today, in terms of the tax credit availability. Tax credits are a huge part of the US economy, frankly, but within this space of renewable development, they cover everything from solar, wind, battery storage, offshore wind, hydrogen, behind the meter advanced manufacturing technologies, EV tax credits, you name it. And so it's a very big spectrum of coverage. Now, our position before the election and still now is that we believe that the rhetoric that we're hearing means that some credits will go, and our view is the credits that are most likely to see resistance from the administration will be electric vehicle and offshore wind credits. And you can only need to Google some of the rhetoric from the incoming administration to see why we think that. On the more conventional technologies, onshore wind, solar, lithium ion, we see a bit of a dilemma in cutting those credits, because a big part of the Inflation Reduction Act has been to support domestic manufacturing of components in those technology supply chains in particular. And so to cut credits with one hand on the developers that demand that equipment would also mean a reduction in the demand on the new supply chain that's being built in the US. So the administration has to be very careful about balancing what it's going to do there. So what we've taken that sort of consideration into account across all of the policies that affect our day-to-day work with advising clients in the US energy markets. We've come up with this slide on screen now. Across the top there, we have a spectrum of what we think is less to more likely based on the rhetoric of coming out of the incoming administration. And we've segmented them down the left-hand side into affordability, sustainability, and reliability. I'm not going to go through all of these today, but basically pink boxes mean we think it's a negative impact on the theme, on sustainability, affordability, reliability. And obviously positioning on the spectrum means what we think is most likely to change and what is probably not. And then we have these little boxes which show whether things can be achievable through executive order, which is essentially a presidential order, Congress, or regulatory commissions. And I direct our collective gaze towards the middle center sustainability there, and how we consider credits, tax credits, which are the big driver of economics of renewables in the US. And as you can see there, we're saying offshore wind, we feel more to the right-hand side of this page. Green hydrogen and onshore, a bit more to the left. And then things like credits for blue hydrogen, CCUS, things that really support the oil and gas industry, advanced manufacturing technologies that support industry much further to the left, less likely to change. So that's our position right now, based on what we're hearing. We'll be updating this in due course once the administration is in and starts making some of its changes. And if you have any other comments or questions in the meantime, feel free to reach out. With that, I'm going to hand to Zhenhui to cover APAC.
Yes, thanks very much, Tom. Yeah, I'm Zhenhui, and I sit in our Singapore office, which is really in the heart of Asia, and I lead our APAC power markets analysis. Now, APAC is actually really a wide and diverse region, different languages, different resource availabilities, and different kind of demand growth profiles, not to mention also different economic structures, for example, with lower interest rates in Japan to more normalized interest rates elsewhere in Asia. And these different factors really shape the economics of renewables projects. Now, I would broadly talk, let's say, from the north first, all the way down to the south. We cover Japan, South Korea, and Taiwan. That's in the sub-region that we would classify as Northeast Asian markets. Japan has been a big and growing market for us in terms of transaction advisory. We see a lot of renewables activity there. Broadly, in terms of PPAs, it's really more of a seller's market. And this is on the back of certain land constraints and grid connection constraints, but really also on the back of growing demand for green power by the different corporates, but also by data centers that's going into Japan. So we see different kinds of activities in terms of asset classes there, utility scale solar. There's some offshore wind activity, although that's a little bit further out, but also in terms of battery classes on the back of the long-term decarbonization auction, the LTDA auctions in Japan. Now, swinging over to South Korea. South Korea of the system marginal price that has been relatively volatile in South Korea, but that has also then attracted particularly certain solar developers to go into the market. In terms of the offshore wind market, it's still a nascent market. The different kind of regulations there are still evolving, particularly with regards to permitting issues and grid connection issues. But we see that that is a key market for South Korea if South Korea is to decarbonize. I'll talk about moving on to Taiwan. Taiwan has a very mature offshore wind market. It has more than 2 gigawatts of offshore wind that's already operational and with a healthy demand in terms of green energy demand, particularly from the semiconductor manufacturers. And in terms of structure of economy, actually Taiwan has a lot of contract manufacturers that supply rest of the world. So they are impacted by global regulations such as the Carbon Border Adjustment Mechanism and also other upstream demands or regulations from their clients to use green power. So that has also been an interesting market, particularly for capital deployment. In terms of solar, there has been some nascent activity using agricultural land, fish farm land, also for solar. Now I'll move on to talk about the rest of developing Asia, which in terms of economic structures are a little bit different, and I'll show some of these trends in one or two other slides later. Vietnam and Philippines, I would class them together really as emerging markets, high demand growth, but in terms of the regulatory regime, it's not as mature. Although there is a difference between Philippines and Vietnam, because Philippines has had a spot and active merchant market for a very long time. Vietnam is still operating more or less on a single buyer approach. But the different green energy auction programs and FIT subsidy programs then provide ballast for developers to go in. But noting that in terms of regulations, they are slightly different as compared to the OECD type markets. Malaysia and Singapore are somewhat closer, although Malaysia is a lower price market as compared to Singapore. There's more scale there that can be done in Malaysia, driven by the large-scale solar auctions, as well as the recent CRESS scheme in Malaysia. Yeah. Now, India is a very big market. Between now and 2030, we're looking at addition of 350 gigawatts of capacity in terms of renewables. Broadly, that's looking like 50 gigawatts a year, which is a very significant amount. Now, I'll move on to the next few slides, and I'll show this slide. This slide really, if you look at the bubbles on the right, represent more of the OECD markets. You can look at the x-axis where actually the GDP per capita is relatively high, and as well that is accompanied by the electricity consumption per capita. Now, for most of emerging Asia, they're more in the bottom left corner, and you can imagine that as GDP grows in emerging Asia, many of these markets are going to move more towards the right-hand part of the chart. And that's going to really provide that lift and growth in terms of electricity demand, not only with regards to electrification of industrial processes, different kinds of needs, not only digital infrastructure needs, but really just growing needs as well as electric vehicle needs. Okay, I'll move on. Two other slides really that show the varying degrees of renewable penetration across Asia. You can see here that really many parts of Asia is still operating on a thermal fleet. Of course, Australia is the most advanced, and followed by Vietnam and Japan in terms of percentage. But really there is that potential for investors to go in and look for the right opportunity. Now, the key point really is how do investors create a protective moat around their portfolio, how they can structure a portfolio that allows them to play across different markets in Asia, particularly because of the fact that markets in Asia are sometimes driven by auction processes, for example, offshore wind auction processes, but there are also solar auction processes. So in order to have that regular cadence of projects going, there's a need to have that kind of portfolio. Okay, I'll move to the last two slides. This is really a slide, a replica of the previous one, but in a different format, showing the different grid emissions factors of markets in Asia. And really, there's a question around, in order to reach net zero by 2050 for some of these markets, the investment, the scale of investment that has to go in is really quite significant. The last slide I will talk about is really on India. Now, India, it's a complex market. It's a very big market, and there are different kind of processes like the round-the-clock RTC contracts, FDRE contracts, that requires a combination of solar, wind, as well as pump storage, hydro, and batteries in order to meet the profile needs of the off-takers of the discoms. And that has created certain almost 24/7 light premium for renewables that makes India an attractive market. Yeah. Okay, I think with that, I've taken everyone on a tour of Asia, and I'll hand it back over to Mark.
Fabulous, fabulous. Thanks so much, Jean-Louis, Francesca, Tom, Gerardo, for sharing your insights. There was a lot to get through there. We've got a little bit of time now for Q&A. So we've had a number of questions through already. Do continue to put your questions in the chat. We can answer those as well after the session, I think, with people bilaterally. I think one that has come through, I think is quite interesting, is on negative price risk. This is a theme that we talk about quite a lot with clients. Question is, what are our thoughts on negative prices for the coming years? Do we expect the risk to increase? What are the factors around that? I wonder if I nominate one of our experts here. Maybe I'll ask Fran for you to maybe have the first say on this.
Yes, Mark, it's probably my favorite topic lately in all discussions with clients. So I'll just say a few things. It merits like a much bigger discussion, but a few highlights. So one concept, I would love people to pay attention more to the distinctions between what it means negative prices. Do we mean deep negative prices as minus 50, 100 or plus, or the near zero negative prices, first of all? Second of all is, what is the market fundamentals showing us? It was the commercial contractual angle related to PPA settlement, CFD mechanism settlement. So very briefly, we do expect across Europe, broadly speaking, deep negative prices to decline over the next decade, faster in some places, a bit longer in others. But the near zero, so the less deep negative prices, to stay there and potentially increase. So the key question is, what are your contract, what are your subsidy doing around the settlement, and therefore impacting your revenues? And happy to take that on bilateral discussions.
Brilliant. Thanks so much. Thanks, Francesca. I'm conscious that time is slightly running away from us here. We've got quite a lot of other questions, but what we do have the ability to do is to follow up, I think, on those following this session by email. So we will make sure that we cover all of the questions that have come in. I think there are a couple just on coverage, and we acknowledge that there are some gaps in this index, and a lot of that is around, where we have coverage versus regions we don't. Also, the kind of relative maturity of regions. So again, kind of acknowledging a couple of points around some of the gaps in the index, which is completely sort of deliberate and is a very good point to raise. So I think time, I say, running away from us. So I might draw us to a close so that we can finish broadly on time. Thanks everyone again for joining this session, and thanks to all our speakers. I encourage you all to, first of all, access our full market scanning report. I think there's a link on the screen via a QR code. Do have a look at that. Also to explore our global market report service and coverage, again, details via the QR code on the screen. And do, of course, reach out to any of our speakers or to me to discuss any of these topics further. So thanks so much, everyone, and goodbye for now.
Thank you.